Hi, this is Greg Sierra, and I am here talking about lessor accounting. This is a kind of an introduction overview, and we'll see if we'll get into the classification. So, lessor accounting. The lessor, as we talked about in a prior lecture, is the party that owns the item, lets the lessee use it, and for that, they'll receive payments. In terms of what you need to know first how to classify a lease. So we're going to talk about two types of leases for the lessor. There's an operating lease and a sales type lease. So the operating lease is, first of all, it's just not a sales type lease, and we'll see why that is in a minute. The sales type lease, we have to check some boxes off to see if it's classified like that for accounting purposes. And we're really talking about the accounting because from a finance perspective, they're not too worried about classification. The classification in accounting will dictate how you account for the lease. The second part you'll have to learn is capitalization. So if it's an operating lease, nothing's capitalized. If it's a sales type lease, we're going to capitalize a lease receivable. Capitalize means to recognize or record a long-term asset, and the lease receivable is a long-term asset we're capitalizing. So you'll remove the inventory, and then we'll also record sales revenue and cost of goods sold because it's like a sale. Okay. And the third part is revenue and expense recognition. So after the initial recognition, then you will have to recognize interest expense, and or interest revenue, excuse me, and that'll be on the effective interest method. Over here, you're just going to have lease revenue. It's like rent. You get paid rent. You recognize the rent revenue as the credit. And then at lease maturity, nothing special going on over here. So the lessor removes the item under a sales type lease. At the end, they have to bring the item back on the balance sheet at fair value. And they'll recognize the gain or the loss at that time. All right. So I'm going to skip the payments, and what I'm going to go to first is just talk about that classification. So this is one skill that you'll need to know, because before you can determine how you're going to account for a lease for the lessor, you have to classify it. So first of all, even though we're learning lessor, I want to point out that these rules apply also to the lessee. So we're getting a little bit of a twofer here. Now, if a non-cancelable lease meets any of the following tests. So non-cancelable, it has to be non-cancelable because we're talking about a long-term asset. If you can cancel it, it can't be long-term. If a problem asks you to classify a lease, that would mean, hey, it's assuming it's non-cancelable. All right? So if it meets this test, it's a sales type lease. If it doesn't meet the test, then it's an operating lease. That's why I said above, an operating lease is just not a sales type lease. That's kind of the way FASB has set up this test. It tests to see, are you a sales type lease? If yes, then you're a sales type lease. If no, you're an operating lease. All right, so there's 1, 2, let's look at the criteria, 3, 4, 5 criteria. And if you're non-cancelable, meet any one, then you're done. One and done. Transfer of ownership test, pretty clear. At the end of the lease, does it transfer the item to the lessee? Well, really, they're just leasing to own it, so you're just financing it. So they have this red line. Actually, it's bam, done, straight there. Purchase option test. So some leases have an option that says, hey, you're going to lease this car for 5 years. At the end of the lease, you can buy it for $1,000. Well, if you analyze that purchase option and it looks like they're pretty certain to buy it, so reasonably certain to exercise the technical term, then it's a sales type lease. So the lessee classifies the finance lease and lessor as sales type. Okay. Is the lease term for a major part of the remaining economic life of the underlying asset? So if it's a 10-year life and you're leasing it for 8 years, pretty clear that it's the major part of the economic life of the asset. The present value test. So straight there. So these first, we do these first three because they're pretty simple. This fourth one is kind of complicated. Does the present value of the sum of the lease payments as defined, this is a special definition under GAAP, and any lessee residual value guarantee not reflected in those lease payments equal or exceed substantially all of the underlying fair value assets. So assets fair value. So for the present value test, what you're getting at is you take the present value of the lease payments, present value of the lease payments plus PV of residual value. So basically, you're taking the present value of all the cash flows associated with the lease. And if that's a pretty large amount relative to the fair value, so large compared to fair value, which would be an estimate of what you could buy or sell the asset for, then it's, so say the present value is 70,000 and the you could sell the thing for 100,000. That's maybe substantially all. Okay, so there is some judgment in practice. What I'll say is that the problems we'll deal with, it'll be really extreme, so you could tell right away whether it's a sales type lease or not. And then, is the underlying asset of such a specialized nature that is expected to have no alternative use to the lessor at the end of the lease term? So if it has no alternative, then it's a sales type lease. Here's the idea. If you get some, let's say you have special molds created that make a part for your product that only fits your product, so the mold can only be used by that company. The assumption is anybody who leases that must have been doing it to finance it, and it's got to be over the life because the lessor can't get that item at the end of the lease and lease it to anybody else. Okay? So if all the answers are no, then it's an operating lease. So no, operating lease. So an operating lease means it just doesn't meet any of the criteria for a sales type lease. All right, so that's classification. Once again, that's like its own special skill. You might get a question just on it. Regardless, you have to understand that the accounting for leases, both for the lessor here and later when you get to the lessee, are always dictated by the classification of the lease.